Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. Today, we're discussing the past week's much-anticipated quarter-point Fed rate cut, the first such cut this year. This, of course, was set against a backdrop of President Trump having previously criticised Fed Chair Jay Powell for not cutting rates sooner. A top voice from UBS Investment Bank here in London is with us on the programme to look back on the week that was, to make sense of the moves and to consider where opportunity and perhaps risk might lie for investors in the light of the Fed's moves this week. So, on with the show. Jerry Fowler is Head of European Equity Strategy and Global Derivative Strategy at UBS, based in London. It's great to have you with us, Jerry. Now, Jerry, back to, sort of Wednesday afternoon here in London, a very well-telegraphed rate cut from the Fed. Nevertheless, roll the clock back at that moment. I guess that probably confirmed yours and most other watchers' expectations. But in that moment, what are you thinking about when the cut is confirmed?
Well, it's great to see that this cutting cycle is underway, certainly for investors who were looking forward to it. And if they didn't get it, there might have been a little bit more consternation in markets. Initially, it was perhaps treated a little bit hawkishly because there was an expectation there'd be a few more dissents for more rate cuts. Although I think as the dust settles, there'll be a realization that there probably are several more cuts coming. And the most recent addition to that board, Governor Moran, has some dots that imply 50 basis point cuts per meeting for the rest of the year, and that might well be perceived as the direction of travel for the Fed into next year, that it could just be a lot more easy relative to where the economics is at the moment.
Yeah, exactly. And then I guess also, it's always interesting to hear then from the chair. Jay Powell spoke, I think, just after the cut was confirmed. What did you make of his remarks? Because again, I think it was largely in line, but he sort of got into some of the detail. And obviously, there's kind of lots of politics broiling around this as well. What did you make of what he said and how he said it?
Yeah, sure. I mean, I think he did a very good job of ensuring that the perception of Fed independence was reinforced, that there was a reasonable amount of consensus, that this was one cut, in theory, justified by the data. He highlighted the weakening of the jobs growth data and, so far, the relative absence of significant inflation passed through from tariffs. Now, we'll see how that plays out. I think he also rightly pointed out that much slower immigration in the US means that there's likely to be much less job creation in the US as well. So we can't be quite sure yet whether the economy is actually slowing in terms of job creation relative to the people who want jobs, the unemployment rate, or whether this is just the fact that the working age population is not growing at the moment. So if the latter proves true, then the Fed is cutting to some extent unnecessarily. So we'll see how this progresses over the next few months as to whether those extra cuts that are priced into the market and will probably be delivered are necessary for an economy that, apart from jobs, seems to be hanging in there quite well.
Yeah, and just sorry on that, that's interesting, that job situation, because it was a little weaker than we were perhaps expecting if we go back to the start of the year. But then he was at pains to point out this was about nitty-gritty, wasn't it? Data collection and poorer response rates for employers. So we do have to sort of be somewhat guarded, I guess, right, when we look at the raw data.
Yeah, there's certainly a lot of uncertainty at the moment. I mean, one thing that does look fairly apparent is that if you look at things like the Dallas Fed Weekly Economic Indicator or the Atlanta Fed Nowcast, overall US growth doesn't seem to have slowed a great deal, even though job creation has. Now, that really just points to the potential that productivity is growing quite quickly. We can see that in the markets as well, that without adding employment, companies are still upgrading their earnings estimates. So this could be cyclical, where it's simply just a quite late cycle environment. Companies aren't hiring, they're able to squeeze a little bit more revenue generation out of their workforce. But it also might indicate that there could be an element of AI productivity starting to permeate out from some of those larger tech companies to the broader economy.
Yeah, that's also really interesting. And just before we sort of interrogate what this might mean for investors, Jerry, in a second, but just on housing again, because that's another one that people often say, well, what does this mean straight away? And again, Jay Powell said, look, most of my team, most analysts think it doesn't really make that much of a difference. I think he even said a quarter point won't make a big difference to the economy. And on housing, I guess that's true. It would have to be a lot bigger to make a big change. Anything that you would sort of dissent about in that view, do you think?
No, I think that's about right. I mean, the mortgage rate at the 30-year has been coming down for a while. It did continue to come down after the meeting, even though we've started to see what's called a little bit of steepening in the curve, where because of the potential for either further inflation increases or the possibility of inflation expectations going up, we have seen 10-year bond yields and Treasury bond yields start to rise. But so far, I mean, if we go back even just to January, that 30-year mortgage rate was up at about 7.4. It's now down to 6.4. So it doesn't make a huge difference, considering that these are still very elevated mortgage rates compared to where most people have mortgages at the moment, which is probably somewhere down around a 4% level. But nonetheless, at the margin, it might start to create a little bit more turnover and a little bit more activity in the housing market, which can only be good for the broader economy, because that type of spending can be very beneficial broadly across an economy.
Indeed. Right, Jerry, let's interrogate a little bit then about what this might mean for investors in the US in particular after a Fed cut. By the broadening, that could be one little phrase. What do you and your colleagues mean when you say that?
Yeah, so buying the broadening really is just a view that, apart from perhaps some specific names that are still generating quite a lot of revenue growth from AI, the performance of the market has been very led by the top-end technology and communication services companies. Sorry, it has also been led by those AI companies. But while they may continue to power on, the broader tech space has become pretty expensive and pretty crowded, and yet there's been a real lack of investment in the rest of the market, in part because they haven't been able to gain any momentum. But with rate cuts, that helps some of these companies that have a slightly higher debt burden, so it helps on the interest expense side, need a little bit more consumption and growth activity to come through to support them, which rate cuts can support. You may well see the performance of the market broaden out somewhat, and that's not just from US large caps, perhaps to US small caps, which, by the way, is a very under-owned trade. The market is very long large caps and pretty short small caps. But it also means globally, particularly if the dollar weakens. So a lot of investors have a reasonable amount more bullishness and expectations for significant performance in things like emerging markets in Europe as well.
Well, yeah, and I guess if we look at sectors, it's interesting, isn't it? Because often these kind of news events feed into big ongoing secular trends. And if you look at areas like utilities or renewables, healthcare, of course, maybe those sector by sector are also some of the areas that have maybe greater value given that backdrop?
Yeah, certainly if the long-term bond yields come down, because that helps with the broader valuation in some of those bond yield interest rate sensitive sectors. But even just those that have higher debt burdens, but shorter debt maturities, so often that's quite a lot of small caps, things like the Russell 2000, they can benefit just outright from lower interest costs on their loans, which just increases their profits and profitability. So we're hoping that this rate cut sort of delivers a little bit more momentum to the broader US economy, which seems to be trundling along quite nicely, although mostly led by a lot of these investments in capex in AI and data centers, and perhaps an element of the reshoring narrative coming through post the US budget a couple of months ago.
Okay, Jerry, let's track our way across the pond. I'll ask you about the UK in a second, but just in terms of the European picture, again, from an investor's point of view, an opportunity maybe to buy the upside here on the block?
Yeah, I think so. So we've been of the opinion, and correctly so really, that Europe was trading sideways for the last few months. And that's because there are some good things happening in Europe, mostly domestically. And so we've seen pretty strong growth and pretty significant upgrades to things like the defense spending beneficiaries, lots of the banks, more broadly the industrial, some of the utilities, telecoms, all domestic sectors. But if we look at the larger companies in Europe, they tend to be the ones that have benefited for a long time from exports to China and the US, and therefore a weak currency, weak euro. And they've been really hurt significantly by that rise in the euro and by the tariff escalation. But at this point, it does look like that acceleration in domestic activity that we're expecting in 2026 is starting to come through in new orders, at the same time that the currency headwind and even the tariff impact is becoming a little bit more stock and sector specific, so not dragging so much of the market lower anymore. And so that just opens up a bit more index regional level upside, even more upside for some of those domestic themes. And from a valuation perspective, Europe's valuation at around about 14.5 times earnings, it's quite a lot cheaper than the US, justifiably, based on its current level of relative profitability. But bond yields and credit spreads have been coming down and down and down, and that changes the discount rate. It makes equities more valuable. And so because equities in Europe, we think broadly are going to experience some earnings growth next year for the first time in 3, we do think that that valuation is too low because it essentially reflects another year of European growth stagnation, which is unlikely at this stage.
Yeah, and I mentioned the UK. Let's take a quick kind of glance around. What's the opportunity here? Because to that point about, thinking global when looking for value in these moments after a Fed cut, where is that value in the UK? I mean, buying opportunities, maybe not in the kind of FTSE 100 space, but more in the kind of smaller, medium scale, would you say, Jerry?
Yeah, exactly. The FTSE 100 can be very currency sensitive and much more sensitive to what's happening globally because these are big exporting companies. The FTSE 250 is a lot more domestic and it's also a lot cheaper at the moment. In fact, it's cheapened considerably since the Brexit vote nearly 10 years ago, especially on a relative basis, both to the FTSE 100 and globally. So this is a really ignored part of the market. Now, if the UK can gain a little bit of growth momentum, and we believe it should because real incomes have been rising for several years now, then the FTSE 250 may well start to see some of that earnings growth translate into better index level performance from a pretty cheap level. Now, what's holding things back is just a lot of uncertainty around the debt sustainability and the fiscal rules that the UK government has imposed on itself to contain those risks. So we've got a budget coming up at the end of November now. There's a reasonable amount of uncertainty about what that involves, and to be honest, a reasonable amount of pessimism about what that will result in. If expectations are too low and actually that budget perhaps does deliver some things that the market perceives to be more growth positive, then there's plenty of room for the FTSE 250, those smaller, more domestic companies in the UK, to really have a bit of catch up to the rest of Europe and to some extent global earnings growth trends and valuations.
Let's just zoom back out again and we cross back over to the US. It's interesting. I've seen some interesting sort of ways of describing the economy, saying, the US economy, it's always a puzzle, but at the moment the kind of pieces don't quite fit together. We've obviously got more information. We've had that rate cut, but there's still this sense, isn't there? A bit of disagreement really in certain quarters. Some people say, we're on the brink of recession, others that it's actually a bit softer. Do you think we've got a better picture yet of where the US is and whether that puzzle looks a bit more coherent? And if not, what are we waiting for? What do we need to see to get that more holistic and complete view?
Yeah, it does appear that there is a slowdown underway, especially in real terms. So even retail sales, which were apparently quite strong in the last week, when you back out the inflation, retail sales were basically falling still. We've got much weaker jobs growth, partly because of much weaker immigration, but also much weaker hiring activity in general. So at the moment, I think it is reasonably clear that there is a picture of a slowdown underway, certainly in real terms. Nonetheless, the economy and growth is still pretty well supported by that consistency of above target inflation. So at the moment, we're sort of in this muddling through slightly Goldilocks phase where neither growth nor inflation are too hot. If you look in bond markets, the yield at the moment in the US is about 4.1 out to the 10-year maturity, and that's roughly half split between the inflation expectation and the growth expectation in real yields. And so what we need to see is which direction is particularly that real yields traveling. Are we seeing rising yields because of rising growth expectations, or are we seeing rising yields because of rising inflation expectations? And worst case scenario is we have falling growth expectations at the same time that we have rising inflation expectations, that stagflationary impulse. So I think, just seeing where the market is interpreting that data on both growth and inflation is going to be really important for whether the equity market can broadly sustain performance and whether risks in the market remain contained.
Jerry, just a final note. We've been talking a little bit about opportunity. On the flip side, of course, always jeopardy, always some risks. What's the kind of risk appetite at the moment, and what does the sort of risk horizon look like as you see it?
Yeah, so at the moment, investors are pretty well invested, and I would say heavily invested in certain key themes like AI, although by and large, those have been justified by the earnings delivery that we've seen. So the risks would be if there is any, downturn in that earnings delivery, particularly because now you've got some of these hyperscalers spending 26% of their sales on new capex. And that's quite hard to continue justifying unless your sales continue to grow as well. So there is potentially some risks around that. But equally, there's upside risks because with the Fed having cut rates, potentially, it's only 25 basis points so far, but let's assume we get several more rate cuts through to the end of the year that perhaps is more than what the market perceives as necessary. That's the sort of thing that Andrew Garthwaite, our global equity strategist, points out would be the 7th out of 7 criteria that he's got for creating a bubble. Now, we're not in that yet. Valuations can be justified by earnings, etc. But if we are entering a bubble, then to some extent, this market could run a lot further to the upside. And as it did so, create a lot more risk that at some point you get a much more sharp contraction in both the market and ultimately the economy.
Jerry Fowler. And that brings us to the end of this edition of the Bulletin with UBS here on Monocle Radio. You can listen again and explore more at monocle.com or follow us wherever you get your audio. And if you would like to discover more and find out how UBS can help you, just head over to ubs.com. This is the Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.